Good morning, students. Today we are going to study about monetary policies. Monetary policies adopted by Reserve Bank of India. Okay, so first we need to understand what is monetary policy. So, monetary policy constitutes steps undertaken by monetary authority which bring about changes in the stock of money, source of money and cost of money. That is, in simple words, monetary policies are tools in the hands of apex bank, that is for India Reserve Bank of India, for the purpose of achieving general economic objectives through monetary policy by regulating the supply of money in the entire monetary market of any country. In the simpler terms, policy undertaken by apex banks for regulating the supply of the money in order to maintain the economic stability and the process of economic development should go in the interest of the public is known as monetary policy. So there are various kind of monetary policies adopted by RBI in India. They are bifurcated into two parts. First is quantitative measures, that is also known as general measures, and the another is qualitative measures, that is known as selective measures of credit control. Today we are going to cover the topic of quantitative measures. Now, quantitative measures, in that first one is bank rate. Now, what is bank rate? Now, what is bank rate? We have studied that whenever any bank faces the crisis or shortage of money, it has to take the loan from RBI. Now, RBI does not lend the other scheduled banks money freely. It charges some rate of interest like bank charges from general public. Similarly, RBI also charges a rate of interest on its credit given to its scheduled bank in the time of crisis. So, the rate at which RBI lends the money to its scheduled bank is known as bank rate. Now, let us see how, by using the tool of bank rate, RBI controls the supply of money in the country. Now, for the long term, whenever any country is supposed to have inflation, RBI is going to increase the rate, that is bank rate, so that scheduled banks also lends the credit to the general public at increased loan rate. As a result, general public will reduce the loan taking from the scheduled banks. So, up till that amount, the purchasing power capacity of the general public will reduce. As and when the supply in the money will reduce, demand for certain products will also reduce. As a result, inflation can be curbed and the inflationary pressure in the economy can be solved. Whenever RBI finds that there is inflationary pressure in the country, to reduce the supply of money, it increases the bank rate. As a result, the loan rate charged by scheduled banks to the general public also increases. So, the loan becomes expensive. Similarly, also the other bank loans will reduce, so the purchasing power capacity, that is the demand for certain goods, will reduce. As a result, the inflation can be kept in under control. Now moving towards the another quantitative measure, that is repo rate and reverse repo rate. Whenever commercial bank needs fund for very short period of time, short period of time ranges from 1 day, 7 days or 15 days depending upon the circumstances. They sell some securities which are held by RBI held by them to the RBI with a repurchase agreement at a particular rate. This rate is called repo rate or termed as repurchase rate, that is reverse repo rate. Banks sell government securities to RBI in order to raise money for a very short period of time with a condition to repurchase them at certain rate, certain discount. That discount rate is known as repurchase rate or repo rate. In the circumstances of inflationary pressure in the economy, central bank increases this repo rate as this act as a disincentive for banks to borrow for the central bank. That is, in simpler language, borrow becomes very expensive for the banks. Subsequently, they lend to the general public at a very higher rate, and as a result, people borrow very less amount. Thus, money supply is kept under control and inflation is arrested. Reverse repo rate means the agreed rate upon which RBI repurchases its security from the commercial bank in the event when the RBI has to borrow short-term funds from the commercial bank by selling its security with the commercial bank. So it is a reverse thing. Whenever RBI requires funds, whenever it sells its security to the general commercial banks for raising the money, it's known as reverse repo rate. Even the RBI sells government security held by its commercial bank under the condition of repurchasing those at a discounted rate at the end of short period for which the money was borrowed. An increase in a repo rate means the commercial will get more intensive to park their funds with the RBI by lending more to RBI because they are going to earn more interest on the lended fund. So thereby decreasing their lending to the general public because there they are going to get very lesser interest, and by lending it to the RBI by the way of purchasing the securities from the RBI, they are going to earn much more interest than by lending it to the general public. As a result, the supply of the money which should go by the way of borrowings to the general public is diverted to the RBI in the form of government securities. So whenever there is increase in repo rate, supply of money in the economy reduces and inflation can be kept into control. So let us see towards the data. In April 2016, the repo rate was 6.5 and reverse repo rate was 6%. Okay, now moving towards the third, that is stabilization under emergency situation. There is a special window for banks to borrow from RBI against approved government security in an emergency situation like an acute cash shortage. This rate is higher than a repo rate. In 2016, this rate was 7%. This is also known as marginal standing facilities. So whenever any commercial bank experiences acute shortage of cash, it borrows from the RBI. But here, taking the advantage of the critical situation, RBI charges much more than normal repo rate. Okay, now moving towards the fourth, that is cash reserve ratio, shortly also known as CRR. Now, under the RBI Act 1934, all the commercial banks have to keep certain minimum cash reserves with the RBI. As we have seen it, that like general public also maintains certain minimum deposit with the commercial banks. Similarly, commercial banks, scheduled banks also have to maintain certain minimum cash reserves with the RBI. Initially, cash reserve ratio was decided to be 5% of the demand deposit and 2% of the time deposit. Demand deposit means saving account deposit and time deposit means fixed deposit. Further, it was variable as per the requirement felt by RBI looking towards the circumstances in the economy. Since 1962, CRR is variable between 3% to 15%. That is, it is ranging from 3% to 15%. It is changed according to the demand of the situation prevailing in the economy. Now, CRR fulfills the need of comfortable amount of cash reserves with the banking system. In case many customers start withdrawing their deposit and banks have to provide cash against their deposit. Besides, this is also used as an instrument to control inflation. When CRR is higher, commercial banks have lesser deposit money to create credit, that is, to lend the money to the general public. As a result, the supply of the money in the country will reduce and inflation can be curtailed. CRR is reduced in times of deflation and depression to increase the supply of money in the economy, to reduce the demand, to give the demand push so that the depressionary pressures in the economy can be kept in control. As we all know that inflation is bad but deflation is worse. So CRR is used as an effective tool to check the inflationary and deflationary pressure in the economy. Moving towards the fifth tool, that is statutory liquidity ratio. Now see what is statutory liquidity ratio. It is shortly also known as SLR. SLR. Now, apart from and in addition to CRR, under the Banking Regulation Act 1949, all the banks have to maintain equal to and not less than 25% of their total deposit. Total deposit includes demand deposit, that is saving account, and time deposit, that is fixed deposit in the form of cash, gold, and unencumbered approved securities, that is government securities, in the form of cash, either in the form of gold. Okay, a higher statutory liquidity ratio diverts banks' fund from the loan and advances to the general public to government securities and helps to meet government expenditure. We are quite aware what is government expenditure. Government undertakes various kind of subsidy project, various kind of welfare schemes, various kind of public expenditure such as electricity, roads, highways, etc. For that, Reserve Bank raises the fund in the form of SLR from the commercial bank. On the other hand, it reduces the capacity of the bank to create loans and raise money supply by credit creation, and lower SLR increases the capacity of the bank to create loans and raise money supply by credit creation. If SLR is higher, people get lesser credit, lesser loans from the bank. As a result, the supply in the economy of money will reduce and inflationary pressure can be kept under control. Similarly, whenever RBI feels that there is depressionary condition in the economy, it will reduce the SLR to increase the supply of money in the economy so that the depressionary pressures can be kept under control. Now, moving towards the sixth tool, that is open market operations. Now let us see what is open market operation. Open market operation refers to the sale or purchase of government securities or bonds by the RBI in the open market. Whenever RBI purchases government bonds from the market, the supply in the economy rises. So bank purchases the bond and gives the money to the commercial bank. As a result, commercial bank will get more supply of money and it will increase the credit creation in the economy. As a result, the supply of the money in the economy rises and depressionary, that is recessionary pressure in the economy can be kept under check. The supply of the money in the economy falls when RBI sells such bond in the open market. On the other hand, the supply of the money in the economy will reduce. Credit creational capacity of the bank will reduce. As a result, inflationary pressure in the economy can be kept under control. Such operations are undertaken to regulate inflation and depression. The instrument was not used in India prior to 1991. We can easily say that the open market operation tool is a gift of 1991 economic reforms, that is liberalization, globalization and privatization. Now moving towards the next tool, that is sterilization of RBI accounts against the shocks arising from the excessive increase or decrease in the amount of foreign exchange. Now earlier all the six tools were to control the supply of money in the economy itself, but here we are dealing with the foreign exchange. So whenever there is increase or decrease of foreign exchange, amount of foreign exchange in the country, RBI uses this seventh tool, that is sterilization of RBI accounts. Okay, now whenever there is excessive inflow of foreign exchange in India, inflow, that is increased in supply of foreign exchange in India owing to the trade and foreign investment. So whenever we are indulging more trade or foreign investment, the supply of foreign exchange in the country will increase. Okay, so RBI indulges in the open market sale of government securities equal to the amount of inflow of the government exchange. So to counter the shock arising from the excessive increase of foreign exchange in the economy, RBI will sell the securities, government securities in the open market. This is done to keep its balance sheet unchanged. Balance sheet, we know now the balance sheet, balance of payment in unchanged owing to the excessive foreign exchange. Thus it sterilizes. Sterilizes means freezes its balance sheet against external shocks which are unseen. It buys government bonds if there is excessive outflow, that is whenever we are purchasing, whenever we are importing, whenever there is excessive import outflow of the foreign exchange, it sells the government it buys the government bonds to keep the outflow of foreign exchange into check. Now, how will the buying and selling of the government bond reduce or increase the supply of money? Now, it is a very simple concept. Whenever government is giving, that is RBI is giving higher rate of interest as compared to import export done by foreign business, the income of foreign exchange, the income of foreign exchange the income done by foreign exchange will be much lesser than the interest rate offered on government securities. As a result, public will not indulge into import and export activity rather than invest in government bond. As a result, foreign exchange shocks can be kept under control. So here we end our lecture with the quantitative measures. We will continue in the next lecture. Thank you, students.